It's another busy earnings week with several hundred companies reporting. And I know now that FANG is mostly done, we haven't heard from NVIDIA yet, so that's why it's mostly. People get a little bored with earnings season, right? But these are companies that are in interesting industries here in 2023, including a lot of travel companies. We get some of the retailers and some big name S&P 500 that are outside the FANG men. So which one should you be watching? As always, I've brought you 5 earnings charts that you should be tuning in on. Let's see what they are. So the first stock out of the gate is one of the ones that I know many of you own, Disney, ticker DIS. Now it's kind of interesting to look at this chart, right? They have a not so great earnings surprise track record now. And they've had those 2 misses out of the last 4 quarters, but you can also throw in that other miss in the last 5 quarters. So that's not that great of a track record. So we all know some of Disney's struggles here. It is trading off of its lows, but over the last year, still down about 23%. And then given that this is a 5-year chart, you can see it's kind of trading down there. It's trading near those 5-year lows. So up only just 6.3% over that 5-year period. And meanwhile, the S&P 500 is up 57%. So this chart kind of illustrates why it's so difficult to beat the S&P 500. You would think owning one of these big name, well-known, highly regarded companies like a Disney would be fairly easy to beat the S&P 500. But over this 5-year time period, which includes the pandemic, the answer is no, it's not even close. Additionally, Disney is no longer paying a dividend, so you're not even getting a little bit of dividend like you do in the S&P 500. So you're not even making up any ground that way. What does the PE look like for Disney now? The shares are still expensive on a forward earnings basis, trading at just 28 times. So you can tell by my tone here, I'm a little negative on Disney, just looking at just these few variables. It's not cheap on a PE basis, and it doesn't have a great earnings surprise track record. So we'll see what happens this quarter. But Disney, while it's up off those lows, still not a great, long-term investor scenario. Then we're going to switch over to another stock that also has an interesting chart. Now, PayPal, ticker PYPL, has a much better earnings surprise record. It just has the 2 misses in the last 5 years. And prior to that first one in 2020 during the pandemic, it hadn't missed at all since it was spun off from eBay. So this is a good earnings surprise track record, especially during a pandemic. But look at what this stock has done. So it basically has round tripped back to the pandemic and below lows. And over the last 5 years, these shares are up just 14%. And again, the S&P 500 is up 57%. So this used to be the stock that I always talked about as being the one that got away, because I've been following it for years and years, especially on these Earnings All-Stars videos. And I always lamented, oh, it's a shame I didn't buy it in like 2017 or 2018. And now I wouldn't even be beating the S&P 500 or even close. So what does the valuation look like now on PayPal? It was always expensive throughout all those years, which is why I never got in. So it's come down a lot in valuation on a PE basis. It's now trading at 17 times, so that is more affordable, no dividend. And they are cutting costs. There has been some layoffs announced at PayPal. So this is definitely one on the fintech side everybody's going to be watching. Then we're going to switch over to a little bit better area, and that's on travel. And you can see this chart looks much better. Hilton Worldwide, ticker HLT, they've managed to hold on to their pandemic gains, or at least most of it. And they have a pretty good earnings surprise track record going in place right now with 4 beats in a row. It was a little rocky during the pandemic years, as you might imagine, for a hotel chain, but it seems to have figured that out as demand has returned. Now, what are earnings looking like? You can really see the turnaround in the earnings from the economic shutdown in 2020. That happened globally. So in 2021, they made $2.08. Going into this earnings report, the Zacks consensus for 2023 is $5.48, so more than double on the earnings now heading into 2023. Now, maybe they'll warn, maybe they'll say it's not as good, but everybody is still traveling, so that's unlikely. But this is one I'm going to be watching to see if maybe things are even better than what it looks like. So over the last year, what have these shares done? You can see they're kind of just back and forth there in 2022. They're up just 0.5% in the last year, but a 5-year return of 81%. That is beating the S&P 500. They are paying a dividend again, yielding just 0.4%, however. But what is the valuation like? Are they expensive? They've got a PE of 26.7. So not cheap, not sky high, but definitely not cheap. But this is one out of the big hotel chains a lot of people are going to be watching this week. Then we're going to switch it over back to retail with Tapestry, ticker TPR. And if you still aren't familiar with what Tapestry is, remember it's Coach, Kate Spade, and Stuart Weitzman. So 3 powerful brands. These shares were already selling off when the pandemic hit, and then they have been on a tear for the most part. But they have a great earnings surprise track record. Tapestry has always had that. They had a big miss right when the pandemic hit, but then they put together this nice string of 10 in a row here. So the earnings surprise is not really the issue. It is going to be guidance. They have big business in China, so that's been lagging. Is China recovering? These shares have recovered, so they've gotten a nice little boost here. Over the last year, they're up 16% now, but over the last 5 years, still down 6% because of the big pre-pandemic sell-off. But Tapestry has been cheap for basically this entire 5-year period. It is a value stock. It's got a forward PE of 12. It has always been shareholder friendly. It's paying a nice dividend yield of 2.7%. So this is one where we need to be watching to see what they say about China and that reopening. Is it really going to provide a boost for business? And what are North American and European consumers doing? Are we still buying the higher priced goods at Coach, Kate Spade, and Stuart Weitzman? This is definitely one to watch on retail. And then we're going to wrap it up with another travel stock, although, as you can see, this chart does not look as good as Hilton's, and that's Expedia Group, ticker EXPE. I now own it in the Zacks Value Investor because it is a value. So this stock has had a bit of a rocky road on the earnings, misses and beats. It's got a bunch of misses there, of course, during the pandemic, but it did have that big miss there in the second quarter of 2022, and then the 2 beats in a row. So hard to get any kind of pattern on what Expedia is doing on the earnings here. But this stock, as you can see, really sold off. It did join in on the sell-off in 2022, and that's when it became very cheap. So it has a forward PE of just 12.9, and that's after this nice rally to start 2023. So it was even cheaper on a PE basis before then. Over the last year, the shares are still down 37%, even with the recent rally. And the last 5 years, up 15%. So you can see that it too has not been able to beat the S&P 500 over a 5-year period. But we all know travel is on the rise, and especially just globally, we now have China reopened and they are going to want to travel in a big way. How will that impact the Expedias, the bookings, those types of online travel agencies? what's happening with these companies going into this report. Earnings expected to be up 24% in 2023. Will they say that? The earnings rebound off of 2021 even is pretty dramatic. They made $1.65 in 2021 coming out of the reopen for the United States and most of Europe in that year, but expected to make $9.21 in 2023. Can they do it? That's why they're so cheap as a stock. We're going to see, but that's Expedia Group, EXPE. So there's a lot going on with these stocks in different industries, and that's kind of the theme of this week. Is it's not straightforward big tech and whether or not they're going to miss or beat and laying off people or what, if they're going to do a share buyback and that kind of thing. It's not just these straightforward kind of mundane stories, I guess, if you call that mundane. It's more detailed and intricate, and you got to really kind of drill down to see what is happening in the businesses that are reporting this week. Including these travel stocks and the retail. There's a lot of balls in the air. There's a lot of dynamics at work, and we're going to get at least a clue into what they're seeing happening in 2023. And that's the big deal this earnings season. What is the outlook, and can they sustain this kind of earnings growth for some of these companies, especially in travel? I'm going to be tuning in all throughout earnings season, and I'm going to be bringing you even more of these names. So you don't want to miss a single episode of the Zacks Earnings All-Stars, because some of these some have the great earnings surprise track record, and maybe it's the start of a great earnings surprise track record for some others on this earnings report. So be sure to subscribe. Get us on Zacks.com/YouTube on our YouTube channel. You can get them on Zacks.com. You can also see these articles on my Twitter feed at Tracy Reinick, as always, on Twitter. But be sure to get us somewhere, and I'll see you again next time with some more charts.